Welcome to the Financial Foundations podcast, your gateway to the fascinating realm of finance, brought to you by Base Wealth Management. In this show, we delve deep into the world of money, guided by seasoned experts who will unravel the complexities of finance and provide you with invaluable insights and practical advice. Now, here are your hosts, Dustin Taylor and Alex Wolfe.
Welcome back, everyone, to the Financial Foundations podcast, brought to you by Base Wealth Management, where we are the foundation to your financial plan. I'm your host, Dustin Taylor.
I'm your co-host, Alex Wolfe, certified financial planner.
And we just had another question come in, asked in what situation should I do a Roth conversion? So Alex, let's just jump right in and discuss what is a Roth conversion first.
It's a really common question, and there's some gray area when it comes to a Roth conversion, but kind of setting the stage on what it is when you make a contribution into your 401k or into an IRA in the traditional sense, typically you get a tax deduction. So when you do a conversion, you're taking pre-tax dollars and converting it into a Roth. In some 401k plans, you can do that inside of the plan, or if you're doing it in an IRA, you just convert that money into a Roth IRA and you pay taxes on that amount that you convert. And it can be a contribution, or it can be growth, whatever that amount is, whether it's $5,000, $10,000 or more, you pay taxes with the notion that whenever you take that money out in the future, you take it out tax-free no matter how much growth you have on it.
In his question, he asked when you should do a Roth conversion, and today we are going to dive into why you should do that, but then we're going to give you 4 good reasons why you shouldn't do a Roth conversion to kind of bring in the other side of things. So do you want to go ahead and tell us like the primary reason for doing a Roth conversion?
The primary reason why people do Roth conversions is kind of shifting their taxes. So as I mentioned, you're paying taxes now at income tax rates. So hopefully in the future, you're expecting that you might be in a higher tax bracket than you are today. So you're paying lower in taxes now than in the future. And that might be a personal situation, or it could be an anticipation that tax rates are lower today than the tax rates in the future across the board.
Okay, and so is it possible for you to just give us like a quick, simple example?
In this example, that you're converting $10,000 from your IRA to your Roth IRA, that conversion adds $10,000 to your income tax in this tax year. And this has to be done in a calendar year. That doesn't follow the same dates that a contribution does. You know how you can make a contribution for the last tax year by the tax deadline in April. In this instance, it's January 1st to December 31st. And then in the future, as that money, that $10,000 grows, say it doubles to $20,000, and you take out $20,000 from your Roth in 20 years from now, that $20,000 is completely tax-free, which is a huge benefit because it doubled essentially, and you paid no taxes on $10,000 of additional growth.
And for the year 2023, can you tell us what the current contribution limits are?
Into an IRA, your contribution maximum is $6,500, but if you're over 50, it's $7,500. But you can convert more than that. So a common strategy that people use that can't contribute directly to a Roth IRA, they'll do a backdoor contribution where they'll contribute $6,500 to an IRA and then immediately convert it into a Roth IRA. It's called a backdoor contribution.
Right, and I think that we will definitely dive into that in a future episode. So make sure that you stay subscribed and follow the podcast for that. But for this episode, as I said before, we're going to now go into some reasons why you wouldn't want to do a Roth conversion. Alex, what would be reason number 1?
The first reason why you may not want to do a conversion, if you anticipate being in a lower tax bracket in the future or in retirement. So for instance, if you're a relatively modest or low income earner now and retirement doesn't include a lot of spending, or you don't have a lot of income sources and you anticipate being in a low tax bracket due to those sources of income you have coming in, you may not want to convert now because you may be earning more in wages and taxable income now.
So a lot of people that I actually come across, they mistakenly think they're going to be in a lower tax bracket. So can you talk about that a bit in the situations that maybe you've come across?
Right. So when you think about your tax situation in the future or during retirement, you really need to examine the type of taxable income that you'll be receiving during retirement. It could be a pension, Social Security, money taken out of an IRA. Those are the big three items that will be coming in to your pocket or savings account that are taxable income. So if you have a big IRA, and I'm kind of alluding to something we're going to talk about shortly, is if you have a large IRA or a large 401k at a certain age, it's 73 today, but in the future it'll be 75 and could go up from there. You're going to have to take required distributions from those accounts when you reach those ages. And that money is all going to be taxable and could be a large amount of income coming in. So if you have a big retirement account, this, a conversion may be appropriate for you now to reduce that future income, but it could also mean that you're going to be in a higher tax bracket in the future.
Right. So yeah, it's possible that even though you think that you're not going to be working and your income's going to be lower, but you're not actually going to be in a lower tax bracket. Not to mention that tax rates are historically low right now. So I think that from here, they probably can only go up.
Yeah, that's definitely a very common thought in our industry, is that rates are historically low. So they can't go lower, or they could, but it's not likely. So that means that tax rates in the future could be higher, regardless of your tax bracket today.
Okay. All right. Can you talk about reason number 2 that you should not do a Roth conversion?
Reason number 2 is something that I just mentioned, which is anticipating your future required distribution, which is going to be taxed at income tax rate. So if you've got a large IRA or 401k, when you hit those ages, 73 today, 75 come 2032, and whatever it might be in the future, you need to be prepared for that income. And those can be pretty large distributions that you have to take out. And as I mentioned, that's all taxed at income tax rates. It's not capital gain rates. So that may be a reason to do them, but to not do it is if your required distribution isn't going to be that much. So say most of your retirement savings is in pensions or in taxable accounts, not in IRAs or 401ks, and your future required distribution is going to be quite low, then you may not want to do conversions. It may not make sense.
Could you kind of give us an example, maybe like contrast to 2 different scenarios with 2 different couples?
As with any tax situation, when you have a couple, you're typically filing jointly, although there may be some cases where you file separately. Talk to your tax preparer about that. But if you're thinking about future required distributions, and in this first example, you're a couple that both contributed and had good appreciation on your 401ks through your work, and combined you have a large required distribution. And you also need to think about your ages, and if you're going to be hitting RMD age at the same time, or is one going to be hitting it 5 years before the other? There could be examples where you may want to do conversions for one of the spouses if they're not RMD age, but the other one is. Because the thing to keep in mind is when you hit RMD age, you can still do conversions, but you have to satisfy your RMD first. So typically, people convert prior to RMD age. So in that example, if one spouse is much younger, maybe you want to convert their account to a Roth while just taking the other's RMD, but that still adds to your income tax.
Okay, and when you hit RMD age, one tax strategy is to make qualified charitable donations, or QCDs. Are QCDs something to think about when considering a Roth conversion?
Yes, absolutely. And that brings us to reason number 3. If you are charitably inclined or to reduce your RMDs, you're allowed to make up to $100,000 in qualified charitable donations from your RMD. So if you are charitably inclined and you plan to use most of your RMD in the future to give to charities, you may not necessarily want to do a Roth conversion if you're going to give that money away anyway. And that would reduce your future income tax bracket, because every dollar up to $100,000 that you donate to a qualified charity is money not on your income tax.
Is health something to consider when converting to Roth?
I think it definitely is. And it's something that's not necessarily talked about in their industry as often. But one of the reasons to convert is if you plan to live a long, healthy life. But if you're someone who maybe worked an intense manual labor job, or you have health concerns due to family medical history, that would be a reason not to, as you're going to pay taxes on that now and never reap the benefit. So that would definitely be a reason if you have health concerns to not. But on the flip side is if you would like to leave the money to a beneficiary tax-free, if you're that considerate. Some people are like, I'll pay the taxes and I'll let them benefit, as you could convert it and then they don't have to pay taxes when they take that money out as a generous gift to them. But that's the opposite argument, But if you are concerned about your health and don't think that you're going to live, maybe you've been diagnosed with something, cancer, you probably don't want to do a Roth conversion.
And the long life expectancy also plays back into RMDs too. Can you talk about how that might be affected?
It does. So when you think about your RMD, as you age, your RMD gets larger. It's based off of a uniform life expectancy table that the IRS has off of mortality rates or something along those lines. So as you get older, your RMD gets larger. You're taking more money out of your IRAs or 401ks, increasing your tax liability. So think about life expectancy when factoring in or considering Roth conversions.
Okay, and if you do unfortunately have that issue of a potentially low life expectancy, what are some important things you should do maybe instead of a Roth conversion?
If you have medical concerns, other things that you should really consider is if you have access to contribute to an HSA, contributing to that to help cover costs, and you can invest in HSA to help it grow. And then, of course, in our industry, we always encourage people to get the appropriate planning documents done, whether it be your power of attorney, medical, healthcare directives, and your estate plan tidied up. In case of an unfortunate circumstance where you pass away, you want to make sure that you've got beneficiary designations and accounts titled correctly.
Okay, well, we've covered quite a bit of ground here on Roth conversions. Could you just, for all the listeners out there, summarize what we went over here?
Surely. So first, we talked about some reasons why to do a Roth conversion. After we spoke about those reasons, we talked about 4 examples of when not to do a Roth conversion or when it may not be appropriate, such as being in a low tax bracket in the future, factoring in required distributions, charitable giving, and life expectancy and health reasons.
All right, so I think that we've covered a lot of ground when it comes to Roth conversions. I just want to remind everyone to consult with a financial professional or tax advisor when considering Roth conversions, or if you have any other financial concerns, because you really want to give them a full idea of your financial picture so that they can cater a plan specific to you. You can also find more great information, as well as the show notes, at basewealthmanagement.com.
Please also leave your reviews for our podcast on your favorite podcast listening app. And remember to email your questions to us at question@basewealthmanagement.com.
All right, thanks for tuning in to Financial Foundations. I'm your host, Dustin Taylor.
I'm your co-host, Alex Wolfe.
And happy listening.
We hope the expertise shared by our hosts, Dustin Taylor and Alex Wolfe, has left you feeling empowered and informed. If you're eager for more financial wisdom, don't forget to subscribe, rate, and share the show with your friends, family, and colleagues. Until next time, stay sharp in the world of finance.